myself CMA Dr. Gaddam Naresh Reddy, Professor of Commerce, Usman University, Hyderabad. Today we are going to discuss block 5, that is derivatives market. So far we have discussed about capital market, now the debt market, regulations. So, previously we have the other block on the forex market, and this is the derivative market. Now, here before going to discuss about the derivative market, now we have to know what do you mean by a derivative. So, derivative is not a primary asset, derivative is a secondary asset, the value which is derived from the underlying asset. Now, for example, you can take equity shares which are traded in the market, stock market. Now, this is known as a spot market. We have two types of markets, spot and derivative. Spot market means whenever you want to buy these shares or bonds in the market, you can buy the securities and you will pay the money. The money will be transferred from your account to the seller's account. Or if you are selling the securities in the spot market, the shares will be transferred from your demat account to the purchaser's demat account, and money will be transferred from the buyer to your account, because you are the seller. Now, in the case of this, the funds will be transferred within 1 day, that is T plus 1, but anyhow spot in nature. For example, when you go to a vegetable market, whatever the vegetables you want to buy, you can buy and pay the money. That is why it is called spot market. But in the case of derivative market, the whatever the underlying asset you want to buy or you want to sell, they are into the agreement now. Today, the buyer and seller will go for an agreement. The agreement is related to buy the underlying security in the future. Future is nothing but future date. For example, after 1 month, I maybe want to buy at what price? At a specified price today and at a specified quantity. Now, these are the things which the buyer and seller is agreeing today, but the securities which are transferred at a specified period. The specified period is 1 month or 2 months or 3 months like. Now, if it is an equity, we will call it as equity derivative in the derivative market. If it is a currency, we will call it as currency derivative or currency futures, currency options, equity futures, equity options. Not only that, we will also have index futures, index options. Now, we will also have commodities, commodity futures, commodity options, even forwards, swaps. Now, these are the different products, but the underlyings which are going to change. The name of the derivative depending on the underlying. The underlying is currency, currency derivative. The underlying is a gold derivative or gold future, gold option like. So, this is altogether different market. And another important point is, whatever the number of securities which are listed in the exchange, when you are talking about the stock market, Now, for example, 5,000 odd companies which are listed with the Bombay Stock Exchange. All 5,000 companies shares are not into derivatives market. There are certain rules or guidelines which are there. If a particular company securities may be satisfied the conditions, after the fulfillment of the conditions, those securities are into derivatives market. For example, the liquidity of the stock, the history of the company, the number of times which are traded in the last 1 year, now the volume of trading, like that there are certain specified guidelines. If these guidelines are satisfied by the particular company's shares, for example, TCS, Infosys, Wipro. Now, if these shares are already listed with the exchange, these shares are available in the spot market. If these shares are into derivative, means the conditions must be satisfied. After that, this security is available in the derivative market. Second point is, whenever particular securities are into derivatives, now here we have to buy or sell, but only thing is, if it is a futures, equity futures, now we have to pay only the 20% of the value of the contract. That is why when you are having less money, but you can take the position with more. For example, you want to invest some 2 lakhs rupees in the derivative market, 20% of 2 lakh is more than enough to take the position, or 10 lakhs rupees position you want to take. So, 10 lakhs, 20% of 10 lakhs only money is required to take the position. So, money required is less, you can go for the more of the contract value or the size, and you can also plan for the risk mitigation with the help of entering into the derivatives like. Okay, we will discuss initially what do you mean by derivatives. Derivative is very clear, the value which is derived from the underlying asset, and this will be traded in the market. So, in stock market we have index futures, index options, stock futures and stock options. So, these are the basic instruments which are permitted in the stock exchange. Now, we have 3 units to discuss in this particular block number 5, the financial derivative market, financial derivative markets in India, and the commodity derivative market. These are the 3 topics which we have to discuss. Now, initially we have to focus on what do you mean by a derivative, which I already explained. Now, the investors may take the position in the spot market in the form of buying, selling, or exit and entry, or in the form of derivatives also. Now, when you see the history of the derivatives, now these derivatives volume and value is more than the cash market segment today. So, so much of trading which is taking place in the derivatives market. So many new players are into the derivative market, and day by day the number which is increasing. So, which I already explained. For example, you can take agriculture commodities. Agriculture commodities also allowed in the derivative market, because we have the commodity exchanges. Now, commodity exchanges are trading with the commodity related to agriculture, or maybe precious metals, even energy products, and different other products which are also permitted to trade on the exchanges. But these days the stock exchanges are also into the commodity derivatives. not only equity derivatives, commodity derivatives are also permitted to trade on the floor of the NSE, BSE also. Now, the commodity exchanges are also permitted to trade even securities. Now, there is no difference today. The stock exchanges are offering few commodities to the investors or the traders, and even securities also. Even commodity exchanges may also into commodities as well as the securities. What are the characteristic features of the financial derivatives? Now, you know that, which I already explained, it is a contract. There must be an agreement between the buyer and the seller. A contract must be there. The contract is related to what? The contract is related to, for example, I want to buy 1000 shares of TCS after 1 month at 2000 rupees. So, what are the points which are included in this contract? 1000 shares of TCS after 1 month at a rate of 2000 rupees. If the seller is agreed to my offer, the seller will accept. When the seller is accepted, now there is a contract. Now, that contract will be executed in the future. So, that is why it is a contract. The contract is related to buy particular number of securities at a particular price at a particular point of time. They are going to take a physical delivery, or they may be even settle the transaction by whatever the difference is there, the difference will be exchanged in between the buyer and the seller. So, derives value from the underlying asset. Now, what do you mean by a derivative? The derivative is nothing but the value is derived from the underlying asset. Now, simple example, in our day to day life also we are experiencing. So, we have milk, right. Now, with the milk, now we have to derive curd. So, like that, there is no milk, there is no curd, there is no equity, there is no equity derivative, there is no gold, there is no gold derivative. So, like this, the values which are deriving from the underlying, that is why we will call it as derivative, is the value which is derived from the underlying asset. The underlying asset may be, it may be a currency, it may be a commodity, it may be an energy. So, that is power. So, power derivatives also there in the market, currency derivatives also there in the market, even carbon deposit derivatives also there in the market. So, this is about second point. Third is specified obligation. Now, in the case of futures, forwards and swaps, both the parties are having obligation. Obligation means I must sell, and as a seller I must sell, a buyer as a buyer I must buy, because we already agreed to buy, agreed to sell at a particular point of time. These are exchanged and the amount will be paid and the underlyings must be transferred. That is why it is called obligation. Obligation means compulsory, I must obey my whatever the agreement which I have already gave. So, it may be a buy or it may be a sell. So, that is nothing but we have an obligation. Both the parties, buyer and seller, is having an obligation to buy, obligation to sell. So, direct or exchange traded. So, you can buy directly through exchange, that is by exchange traded derivatives. OTC also there, over the counter market, this is outside the exchange. Now, we are not talking about outside the exchange. For example, forward contracts. Forward contracts are outside the exchange, swaps contracts are also outside the exchange will be available, but in the exchange we have futures and options. That is why we will call it as F and O market. F and O market is also nothing but a derivative market. So, financial derivative market. So, there is a physical delivery or there may be a cash settlement. So, exposure to risk, why actually why the investors are enter into the derivative contracts, because I do not know what is the price after 1 month. But what I am doing now? Simply I am holding, I am specifying the price, the 2000 rupees which I want to buy the TCS shares after 1 month. Now, that unknown thing will be known today. So, after 1 month it may be more than 2000, less than 2000 or equal to 2000. These are the three possibilities are there in the market. But my risk is limited to 2000 only. If I am not entered into the contract, my risk may be much higher, it may be 3000, 4000 like that, but I do not want to bear that. I want to know it immediately, now itself. That is why I am specifying the price. Those who are interested to sell, they will come forward and the contract will be there. Now, that is why derivatives are very much required for the risk management. So, risk will be managed. Which type of risk will be managed? The price risk will be managed in the market. If you want to manage the price risk, for example, you may be invested in different stocks, your portfolio value may be 10 lakhs. Now, this 10 lakhs is going to become a 20 lakh or 10 lakh may also become 1 lakh. Why? Because the prices which are changing in the market over a period of time, the 2000 today may be 1000 after some time or 100 rupees or maybe even 5000 also. Now, these are the risks which are there, the risks are called price risks. So, when I am entering into this derivative contract, the price risk will be managed. So, for the purpose of managing the price risk, now the players will enter into these types of the contracts. So, anyhow, what are the types of the derivative contracts in the market? So, we have with us the forwards contracts, futures contracts, options contracts and swaps contracts. These are the very much popular contracts which are there in the market. Now, for example, if you take a forwards contract, forward contracts are the OTC contracts. These are outside the exchange, these are not available in the exchange. So, those who are entering into a forward contract, these are customized in nature. Now, whatever the quantity I want to buy, I can buy, whatever the price which you are going to specify, the buyer and seller will come to an agreement. The date also, even in the case of OTC and ETC contracts. So, OTC contracts are customized contracts, ETC is exchange traded contracts are the specific contracts, specific points which are mentioned by the exchange itself. Now, for example, what are the specifications which are given by the exchanges in relation to the exchange traded contracts? Now, for example, you can take the contract life is 1 month, 2 months, 3 months. So, not more than this. Now, for example, if you want to go with the futures options, futures contracts are available for 1 month, future contracts are available for 2 months, 3 months, option contracts are also available for 1 month, 2 month, 3 months contracts. So, if you want the fractions, for example, I want a contract for 40 days, it is not possible in the exchange, but it is possible in the outside the exchange in the form of the forward contracts. So, that is the greatness of this product, but the thing is the counterparty risk is very high in the case of forward contracts, because no regulatory mechanism is there outside the exchange. Here is we have the regulatory mechanism, like the exchanges are there. Now, not only that, the SEBI is also going to take care of this, and based on this, now these are the very much protected contracts. Now, there is no default risk. So, default risk is almost all nil, because initially when you are entering into the futures contract, now we have to pay the margin money. When the margin money is paid, now we have initial margin, maintenance margin, like when the margin monies are paid, now we are not having any risk in the case of the futures and options which are traded on the floor of the exchange. So, in the case of the forward contracts, we have both the parties are having obligation, but the advantage is it is customized in nature. Now, we have to shift to the futures contract. In the case of futures contract, both the parties are also having obligation, buyer and seller, but specifications are there. With these specifications only we have to buy and sell. The period is specified by the exchange, the margin also is specified by the exchange. Now, not only that, the tick size is also specified by the exchange. Now, not only that, the settlement time is also specified by the exchange. Last Thursday of the every month the contracts are settled. Okay. Now, these are the certain important points which are specified by the exchange. So, both the futures and options almost all same in nature, except one thing. In the case of futures, both the parties are having obligations, but in the case of options, one party is having obligation, the other party is having a right. So, those who are having right, now they may buy or they may not buy, they may sell, they may not sell. For example, if the buyer is having a right which is called call options. So, in the case of call option, buyer is having the right. So, right to buy, right to not to buy, but in the case of this options contract, premium will be paid by the option holder who is having the right. This fellow will be paid to the fellow who is having the obligation, that is called premium, option premium, it is not free of cost. Now, if the right is there with the seller, which is called put option. Now, these are the two important products which are traded in the exchange. The other product is also there which is called swaps contract. So, swap contracts is very simple, the series of forward contracts are the swaps. So, for example, I want to exchange continuously over a period of time with periodical intervals. For example, the government or the oil companies which they are importing crude oil periodically, but the crude oil price in the international market will change. But if you want to enter into the contract, so whatever the price which you want to import the crude oil per barrel, you can specify in the swaps, but here is you can enter for a period of 5 years or 10 years, and every for example, every month you want to import something, the price which you have to specify in advance for a period of even 5 years also. You can go by a fixed rate, you can go by a floating rate or the market rate like. So, that is the greatness of the swaps contracts, exchange of series of cash flows in the future, which is called the swaps contracts. So, these are the important products which are there in the market. So, who are the players in the financial derivatives market? The players are there, the investors are also involving, the speculators, the arbitrageurs, the hedgers. Actually, these three are the important players, hedgers, speculators and arbitrageurs. So, what the hedgers will do? The hedgers will take the position for the purpose of mitigating the risk or minimizing the risk, and the speculators wants the profits in the future, for that they will take the short positions, and arbitrageurs will wait in the market. If there is any mispricing, and now those mispricing they will take as an advantage and they will enter into the market and they will reap the profits in the market. And what are the factors which are driving the growth of financial derivatives in the India? The price volatility which you can manage with the help of entering into the derivative contracts. So, globalization of markets which are taking place, even the BSE NSE is also becomes an international exchange. Now, the international trades which are also taking place in Gujarat, that is GIFT City. Now, the local players which are participating in Mumbai exchange through online. So, everything is online now. So, technological advances, because of the technological advancements, now we are talking about blockchain technology and other technologies, they are following these technologies, and the trade which is improved a lot. Advances in the financial theories which are taking place over a period of time, and this is also leads to the financial engineering, creation of so many types of products in the market, the risk also which you can transfer to the other parties. Now, this is about the period, how the derivatives which are evolved over a period of time. So, but these derivative contracts which are started trading from 2000 onwards. So, after the committee report and all, now we are into the important products. Here is what are the exchanges which are there in the market. Now, exchanges which are there in the case of financial instruments, not only that, even commodity derivatives also. We have multi commodity exchange, we have BSE, NSE for the equity futures options, currency futures options. Now, for stock futures and options, we have different commodity exchanges. Now, National Stock Exchange of India Limited, Indian Commodity Exchange Limited, now National Commodity and Derivative Exchange Limited, Multi Commodity Exchange of India. Now, the various exchanges which are there in the market, these are the exchanges working over a period of time by offering different products to the investors. So, what is the structure of derivatives market in India, which I have already explained? One is OTC, another is the ETC market. OTC market is nothing but over the counter, which is outside the exchange. The products which are traded here is forwards and swaps, and ETC exchange we will experience about futures and options in the form of equity futures, equity options, stock futures, stock options like. Now, what is the commodity derivative? Simple, commodity derivative is nothing but the underlying is a commodity. So, commodity is what? For example, agriculture product, there are more than 100 agriculture products which are allowed to trade in the floor of the commodity exchange. Now, for example, it may be rice, it may be wheat, now it may be groundnut, it may be different types of seeds, oils, and these are the more than 100 agriculture commodities which are permitted to trade on the floor of the exchanges, and the companies which are buying through the exchanges, those who are into manufacturing. Now, even the intermediaries are also buying through these exchanges. So, here is now not only that, we will also have precious metals, gold, silver, copper like, these are also traded in the exchange. Now, what are the types of commodities traded on the exchange, which I have already explained. Now, it may be the energy products, it may be a commodity, agriculture commodities, precious metals, it may be the currency, it may be the equity shares like. So, commodity derivatives. So, what are the major commodity exchanges which I have already explained? MCX, Multi Commodity Exchange, National Commodity Derivative Exchange, now National Multi Commodity Exchange, and Indian Commodity Exchange is derivative and commodity exchanges like. These are all the very much popular exchanges which are there in India. These exchanges are offering different commodities to the players. Now, you can buy and sell in this market. Now, these are the three important aspects which we have discussed so far in the case of the derivatives market. So, one is financial derivative market, financial securities are traded in this market in the derived form. So, which is not in the as it is form, which is available in the spot market, that is TCS shares, Wipro shares, Infosys shares, and other company shares which you can buy or sell in the market. But in the case of derivatives, now we have to focus on the index futures, index options also. All indices are not permitted to go for the trading, only a few indices are allowed. For example, BSE, Sensex, NSE, Nifty, these are the two popular indices. These indices are also allowed to trade in the futures and options market. Now, why the people will select index futures, index options in the market? Because if I may be having the position more than 100 securities or 200 securities by the different institutions, institutional investors are there. For example, you can take Life Insurance Corporation of India, whatever the money which will be mobilized in the form of different insurance policies and all, now they will invest in the capital market, and the insurance company will be exposed to the price risk in the market. So, what they will do? The fund managers will invest in the derivatives segment. Instead of buying too many securities, instead of taking positions in the too many securities, it is a costly affair. That is why they will go into the index futures or index options to mitigate the price risk in the market. Now, like that, this is only a beginning. Now, in the form of what do you mean by the each and every important topic which will be come across in the derivative market like. So, we are into financial derivatives, we are into commodity derivatives, and we are also having what type of market, how the commodity market which is developed over a period of time in India. So, in India initially the futures are accepted, but these futures are suspended, but after the 2000 only the derivatives which are permitted in India, Now, after that we are into stock futures, stock options, index futures, index options, commodity futures, commodity options like. So, these are the standardized products. If the investors want to take the position in these standardized products, now your interest will be protected by the regulators. If you want to select the OTC products, but we have lot of risk is involved in the OTC products, which is called counterparty risk in the case of swaps contract as well as in the case of the forward contracts. But today the bankers are playing an important role in the case of taking mediation. So, bankers are helping to reduce the risk. So, this is all about derivatives market today. Thank you.